Hello, welcome back to the session number 7. We shall continue to discuss a couple of other financial transactions, and we shall also discuss what would be the accounting entries for these financial transactions. Now, as I have discussed in the previous class, as we see more and more such examples, it will make your concept clear, and through this process, we shall try to cover almost every possible financial transaction a business entity undertakes in the normal course of actions. As on June 15, 2020, a business entity is raising loan from banks to the tune of, now let us look at 20 lakhs, and it received the loan in its bank account. Now let us look at what would be these implications. It's an inflow. Next, it's an immediate in the form of a check. So the first entry will be debit balance sheet asset, current assets bank, and second entry will be credit balance sheet liability loan. Very clear why second entry is balance sheet liability loan. It's a temporary inflow. In future, there would be an outflow. So this is a process by which a financial transactions involving a temporary inflow is converted into accounting entries by adopting double entry system. Next, let us look at it. Another example. As on June 15th, if I look at it, as on June 15th, 2020, a business entity is purchasing plant and machinery to the tune of rupees 20 lakhs and payment has been made in check. Very simple. In this case, if I look at it, it's an outflow. It's an immediate outflow in the form of a check. So first entry would be credit balance sheet asset, current assets, bank, rupees 20 lakhs. Second entry, this is an outflow, but this outflow would result in future inflow. So that's why it's a balance sheet item, and it would be balance sheet item under the head plant and machinery. In the balance sheet, in the asset side, we segregate the asset into three parts: fixed assets, non-current assets, and current assets. A fixed assets means plant and machinery, land and building, which is used for more than 1 year for production or sale purposes. A current assets means within 1 year, it would be converted into sales or into cash. So in this case, plant and machinery would be booked under the head fixed assets. Now let us take another example. As on June 15, 2020, a business entity is receiving interest of rupees 1 lakh on fixed deposits. It kept in bank and it received the interest in its bank account. Inflow, immediate in the form of a check. So first entry, debit balance sheet asset, current assets bank. Second entry would be P&L or balance sheet. It's a permanent or temporary. It's a permanent inflow. The second assets would be this part. So what we look at, the second entry would be the P&L income, other income. Same concept. If some income is other than main sales, then that is called other income. So now let us go to another example. As on June 15, 2020, a business entity is repaying an equated monthly installment. Let me correct this because it will not be a, it will be basically what we talk about. It is an. So an equated monthly installment. Now should be an equated monthly installment or EMI of rupees 45,000 for loan taken. EMI means when you take a loan for say 36 months, you pay the entire loan, principal and interest, both in equated monthly installment. That is called EMI loan. Now in each EMI, there are two components. One is the principal component and another is the interest component. In this case, Say for example, out of 45,000, 30,000 is on account of interest and remaining amount is on account of principal payment. The EMI is paid through the bank account. How we can capture this? How we can convert this financial transaction, which is an outflow, into accounting entries? First, outflow, immediate, in the form of a check. So first entry would be credit balance sheet, asset, current assets, bank. Now second entry. Now second entry, if you look at, second entry has got two components. One is associated with repayment of inflow, which has happened in the past. That's the principal amount of the loan. So principal amount of the loan, when loan is taken, out of this loan, principal amount is also getting repaid. So principal amount part reflects the implication as an outflow on account of an inflow which has happened in the past. So that is why 15,000 would be the debit balance sheet liability loan. Now another part which is on account of permanent outflow, that is an interest. So debit P&L expenses, interest on loan amount would be 30,000. Why it is P&L? Because the interest part, for that no inflow has come in the past. It's a permanent outflow is happening. So that is the reason why it is in P&L expenses. So always remember, in EMI loan when it is paid, there are two components. One is a principal component, one is an interest component. Principal component will go to the balance sheet. Interest component will go to the P&L. Applying the same logic, balance sheet, in that case, a balance sheet portion is repaying some of the liability which has come in the previously. So that is, it is going to the balance sheet. I hope I made it clear about that. Next, as on June 15, 2020, a business entity is receiving rupees 2 lakhs on maturity of investment in FD. Out of the above amount, 0.50 lakhs is on account of interest and 1.50 lakhs in account of fixed deposit principal amount. The entire amount is received in the form of a bank account. Let us capture it, same concept, it's an inflow, immediate in the form of a bank. So the first entry, no problem. Second entry, again, we have to see it has got two components. One is an inflow on account of some outflow which has happened in the past. The fixed deposit principal amount. Principal amount as an outflow has happened in the past, now an inflow is happening. So this portion will go to the balance sheet. And the interest income, which is an income, which is not happening, there's no outflows happen in the past. It's a permanent inflow, it will go to the P&L. So in this case, the amount would be the credit P&L income, other income, interest income is 0.50 lakhs and the credit balance sheet asset investment fixed deposit is 1.50 lakhs. So last two transactions, what we have mentioned is that there are certain financial transactions where the second entry can go, both one part can go to the P&L, another part can go to the balance sheet. Is it clear? So this gives the example. Apply the same concept and try to convert the financial transaction into accounting entries. So with these number of examples, you are more or less familiar with the process by which a financial transaction is converted into accounting entries. Thank you very much for watching this video.